Welcome to Swimming with Allocators. I'm Ernest Sweat, and each episode, Alexa Benz and I give you a VC podcast from the LP perspective. You ready? Let's dive in.
On Swimming with Allocators today, we have Frank Tanner of Morgan Creek Capital Management. He gets into their criteria for sorting and selecting managers, why he's specifically focused on micro VCs, and two very early verticals he sees coming up. If you are an emerging manager, Frank is actively investing in first and second funds. This is one you don't want to miss.
Today on Swimming with Allocators, we have the pleasure of speaking with Frank Tanner, director at Morgan Creek Capital Management, which is in the private equity, venture, and real assets markets. Frank is responsible for sourcing managers, co-investments, and secondaries. Morgan Creek's venture arm invests primarily in early stage managers, typically micro VCs, with fund sizes of less than 300 million and often much smaller. We're really looking forward to diving into this conversation. Frank, thanks for joining us today.
Yeah, thanks for having me on. It's great to be here.
So nice to have you. I think our first question, if you're sitting, your desk is alongside these guys who are working in all the other asset classes that you handle for your clients at Morgan Creek. So I'm curious, what's it been like being the venture guy the past 18 months?
Yeah, so we are in Chapel Hill, and that's by virtue of our roots in the endowment world. So we came out of UNC's endowment almost 20 years ago now. So this summer will be the 20th anniversary. So we're excited about that. But yeah, we have invested across all asset classes historically, and that includes both public and private. So across alternatives, private real assets, energy, buyouts, venture growth, you name it. We've probably done it. Over the years, we have specialized quite a bit. So I started as a generalist here at Morgan Creek 10 years ago, and have really kind of found a path within the firm that, one, satisfies my interest, but more importantly is what, the firm and as an organization we're most excited about. So I would say venture as a whole, and this thesis is, decades long in development, has kind of evolved out of, where our convictions lie and the current setup in venture. And so, yeah, I would say compared to the other major private asset classes, venture, specifically early stage, is right there at the top. And then, across, other initiatives we have, equal, as high conviction as anything else that we're working on at the firm. And I think as the firm has evolved, we just have become more and more focused and concentrated in stuff like venture and other, specialized kind of strategies.
Yeah. So is now a good time to be investing in venture, in your opinion?
Yes, not necessarily because of the reset, but I think it's an evergreen asset class. One of the attractions to us about early stage is that it's a bit startups are a bit agnostic to the macro environment to a degree. Like there's great, we all have seen the data. There's great companies started through different cycles. That said, it's not always a good exit environment like we're seeing now. But if you're a long-term investor, you can kind of withstand that, and you just have to have that long-term time horizon to do so. But yeah, on the margin, absolutely, I think it's a better time to be investing now than it was past couple of years, and we see that we have some dry powder that we're excited about putting to work, and valuations are down. We can come back to that, but generally across the board, they're down. Some seed stuff has kind of maintained prior valuations, but for good reasons, and double clicking on that is pretty interesting to do. But yeah, now's a great time. I think it is one of the few asset classes, if you look across alts in general, that offers a degree of uncorrelated returns, and then also a high degree of asymmetry. And there's not many asset classes, that do that on an ongoing basis. Mostly you have to be opportunistic to get, high degree of, kind of uncorrelated returns or that asymmetry, just given how quickly that is arbitraged away. But early stage, I think, is unique in that regard.
Frank, you spoke about how this is an evergreen asset class, but how do we get to the point that we're at today? Could you give us a brief history lesson on the evolution of venture?
Yeah, so like we're probably on this call, familiar with the origins of venture, dating all the way back to 1950s. And for the first 25 or 30 years, it really, like any industry, starts as kind of a cottage industry, right? It's bespoke solutions, very close relationships. Individual partners were typically synonymous with the firm name, right? And that was, how it lasted up until probably the early 80s. From there, we kind of entered into this industrialization era, if you will, from kind of 1980 through early 2000s, kind of through the dot-com bust. This is where a lot of the iconic kind of tier one funds were created that we all know and love. So folks like Menlo, NEA, Bessemer, Kleiner Perkins, Sequoia, all founded kind of in that era. And, it was a great, I guess, time to be investing in venture. Some vintages better than others, obviously. But overall, I think like it was the first opportunity for especially institutions to kind of put real dollars to work in the space. After the bust, dot-com bust, kind of early 2000s, mid 2000s, they kind of shifted to a like very pro-founder kind of mentality and approach to venture. And along the way, kind of, 2010 era, that pro-founder approach also had tacked onto it kind of a services model. And that was with the aim of, differentiating and just winning over, these founders and access. And, I think that was a great era to be invested in venture, and the services model today continues and is like incredibly robust, right? Like if you look at any of the venture platforms, they're can go head to head or beat any other kind of consulting type model or services model that a firm could bring to a startup. But perhaps what we got away from, and this was, partly due to the growth of fund sizes during kind of the past 20 plus years, has been that really one-on-one relationship and what we think of as like a true venture model. And I think there's a really great, opportunity for institutions and asset managers / venture platforms in that kind of scaled venture space. But in a lot of ways, it's opened up kind of an opportunity in space at the earliest stage, that first check, kind of 0 to 1 stage of company formation. And that's where we're seeing this kind of rise of the individual, kind of an atomization, kind of back to what the industry really started as a cottage industry, and kind of one-to-one relationships and building, businesses that way.
And Frank, I was able to read some research that your team produced about this next era that's happening, in which you entitle it The Rise of Keynotes. Can you explain what this group of investors, operators, who they are, and why they're flourishing, and why you're real big proponents of them?
Yeah. So a keynote is kind of, and we can get into kind of our criteria and selection, and looking forward to that. But like a keynote takes a lot of different forms, but there's a few kind of core traits or attributes that we typically, associate with what we've termed keynotes, and think it's the most apt like term at this point to describe kind of what we're after. But the rise of keynotes, like I said, there's kind of the shift away and a core misalignment with large funds and doing, seed and pre-seed deals. And, ultimately what founders are looking for in that partnership, going from 0 to 1 in company building. And that's where Keynote comes in. So it's highly chaotic at the kind of first check stage of company formation. A lot of opportunities out there. And it's not very scalable as a large institution to map and match the highest quality, investor talent to, these founders trying to start their business. So Keynote kind of has two sides to the equation. So one, they have really strong downstream relationships with some of these scaled venture platforms.
Mm-hmm.
And on the other side, they have what we call founder preference and a draw in the founder ecosystem and an individual, oftentimes individual brand or a duo kind of GP situation, but some one-to-one relationship that founders want to seek out. And in aggregate, it's a very much distributed architecture in the ecosystem. But in aggregate, we think of Keynotes as forming somewhat of an organizing layer, to serve up deal flow to these very, important and helpful kind of scaled venture platforms. So that's where we, operate and where we try to, access this innovation economy. We think it's the most exciting place to play. But Keynote kind of sits in the middle of, founder opportunity, like unique insights, teasing out from founders and operators what the future might look like, and then taking a unique view, making selections, and then also generating signal, importantly, to, those larger downstream investors that, and when I say larger, that could be, folks coming at the Series A and sometimes increasingly these days the seed, but not necessarily like the first check into a company.
Okay, that makes a lot of sense because in reading that, I agree with a lot of those points. In Keynotes being the integration layer essentially between founders and the institutional investors. But I can see this going a lot of different ways, especially in the current market we're in, where there's scarcity of capital, where if these mega funds continue to get bigger and bigger and offering a certain return profile and going earlier and earlier, there's a possibility where for those Keynotes who have decided to become more institutionalized as funds, can get choked out. And we've already seen, at the time of us recording this, a number of up and coming solo capitalists, just stopping shop, right?
Yeah.
Throwing in a towel.
Yeah.
But the other possibility you can see is that, does this mega fund actually, grouping or just like a product actually last the test of time? And that could bring people back to, okay, there's still a need for these Keynotes, but these larger mega funds don't need to go so early. So I can see both ways. I don't know if you have a response to that, but that's kind of how I feel like what's the battle. I shouldn't even say battle, but there's a number of kind of multiverse situations that could happen.
Yeah, and I mean, I don't have a crystal ball. None of us do, but I think so time will tell. But I think the Keynote value proposition will remain. There's just the kind of economic opportunity cost for a really high caliber venture investor to sit within a larger brand and not capture more of the economics for themselves and be closer to the founders and be a more meaningful kind of investment in their portfolio, right? Instead of writing checks across a bunch of call options. And if it's truly a craft that they enjoy and pursue, it's better done in the context of smaller funds ultimately. So and then I think founders want that. We've all seen the pitfalls of raising too large rounds and kind of making yourself unattractive for future financings, and founders not wanting to be call options in portfolios, and the signal risk of if a mega fund doesn't follow on, et cetera. So I think that there is going to be a continued need for Keynotes, and I think on the mega fund layer, I think that continues to exist as well. I think they serve a really great purpose and role, and have done really well over the years, obviously, and I think institutions have been happy with the returns, and namely have allowed for scale for the first time ever into an asset class that has been a cottage industry and not attuned to accommodating large checks. Now it can. I think the place that maybe gets, and this might be to your question, the place that gets a little bit tricky is what we think of as like the messy middle. So folks, like key nodes that have done really well. And there's already, in what we've seen, kind of a Gen 2 of like really successful VCs that, have come up in the past decade, but have already scaled beyond like, 100, 150, $200 million, which start to bump into a different, set of like competitive, players in the market that, they might get beat out by Sequoia or Andreessen or someone in context of the rounds that they have to participate in to deploy their funds, their larger funds. So in some ways, like, they started out in with a really great thesis and in a good place in the market, but now have kind of become what they set out to disrupt originally, and have done so by, making it, putting themselves in a more difficult place to operate from a competitive kind of landscape perspective. But yeah, I do think, the top of the market, persists, the mega funds, as well as the key nodes and kind of that organizing layer. First check.
Do you then politely say, "Oh, Fund 3, that's not for us"? That's an interesting kind of conversation.
Yeah, it is interesting. It's definitely unpopular if that does happen. We do our best to kind of tease out and understand the long-term ambitions and goals of the manager. And I've had this conversation with so many GPs at this point. Like it's almost irrational to want to stay small from a purely economic standpoint. If you just run the math, the management fees you start collecting on, increasing size of pools of capital, and namely the expected value of that, those cash flows, essentially guaranteed, like quickly, overtakes any carry that you can earn on a small fund. So it comes down to, why are they pursuing this profession, this job, and this craft? And what we found more than not with, early stage investors that have stuck to it, and there's not many that are, highly successful on their fund 4 and 5, is that there's just a passion for working with startups, and that craft is where, why they wake up every day and go to work. And it's not necessarily the draw of, the, asset management kind of AUM game that's out there. And yeah, I think if we want to operate in early stage, which we do, we have to have that discipline and saying, if you want to scale, that's great. We can still underwrite, even a fund 1 or 2. We do want to be long-term partners, but we do re-underwrite every fund. And if there's strategy drift, that's something that we're highly, highly sensitive to. And not that they can't scale, but more often than not, size is the enemy of returns. And it's not a situation that we lean into necessarily.
Yeah, no, your data that you compiled, I guess it's Cambridge Associates data, but you put it in a way that was very digestible, showing just that the top funds that are returning really are the first and second funds. It's nice. It's not personal. It's, it's like, this is where you want to play, and it's not a loyalty. Yeah. It's not about loyalty. Yeah. Any other general advice? You've kind of laid out criteria of what you're looking for in these micro VCs, just for anybody who's listening.
Yeah, I guess like maybe double clicking on some of these like criteria, our framework for selecting, and maybe this could be interpreted as advice out there in like how to construct portfolios and why, what differentiates certain VCs from others. But yeah, ultimately, like if you think about how we look for and select managers, we think about, it's an overused term, but first principles of what any good venture capitalist has to do well, which is source, select, and support. And we kind of bundle up some, other skills within those 3 terms, but the 3 S's are easy to remember. Within select, for example, you also have to access. You can't select anything you can't access. And then, every follow-on deal is also a additional selection. So, or follow-on investment. So your ability to double up into winners is a trait of, some of the most successful VCs, and that is kind of captured in selecting. And then when we think about, how we evaluate each of those categories, we essentially create a matrix of these different attributes that intersect or not with each of those three S's. And they're centered around things like, brand. Like I think for any venture capitalist, regardless of size, the brand, carries the day, and that helps across all three of those aspects. Their ownership, their founder resonance, which I touched on earlier as being like one of the key attributes for key nodes. Fund size and construction, right? Like if you're too large and you have 300 companies in your portfolio, it's going to be difficult to have a one-on-one relationship and support all of those underlying founders in a real way. Similarly, if you're undersized and you have 5 deals in your fund, I'm not saying it won't work, but that you're kind of decreasing your probability of meeting the mark on selection, right? You have to be highly, have a really high hit rate, essentially to check that box. Culture, philosophy, and getting to like what is the long-term vision of the firm. Do you want to scale into $1 billion franchise, or do you want to stay small and do this craft? And then maybe most importantly is your network and community. Like, and that factors into all three of those things. But ultimately, like we lean less on kind of the selection and prowess of a GP, because a lot of times there's not data out there to be able to pick essentially, but more kind of look into and do a lot of diligence on where they sit within the broader ecosystem, what their kind of GP strategy fit is, and in a lot of ways, like networks filter for the deals, and like and then in a portfolio that we construct, we get that diversification. But for any given network or part of the venture ecosystem, startup community, like we are kind of underwriting the VC's network to filter the best deals, and that's like where a lot of the implied selection comes from. We're not trying to necessarily bag folks boiling the ocean and selecting from that. It's more kind of network driven. So that's kind of how we think about the universe and choosing where to spend time. And then there's a whole nother layer of portfolio management to that, which we can also get into. But so yeah, I guess advice to, I wish I had a foolproof advice here for new VCs, but like in a similar way to thinking about product market fit with startups, like I think it was Mike Maples from Floodgate that put it this way, but product market fit can be described as like what can you do that people are desperate for? And I think like that's a good way to characterize GP strategy fit for key nodes. So like why are founders seeking you out to partner with you, and then what signal do you generate for downstream investors? And I think that's one of the key questions I would ask for any venture capitalists. And then on the LP side, just understanding if folks are even in a position to allocate and what their kind of portfolio considerations and objectives are at this point in time. And like that's such a big driver. I think it's underappreciated. There's a lot of strategies we like, but we also have this top-down context of what the portfolio needs and LP's objectives, et cetera. So yeah, I guess all advice taken with a grain of salt, but that's kind of how I would maybe characterize some of that.
Yes, this advice that you should ask the LP you're talking about their portfolio.
Yeah, exactly. Exactly.
This is a great. We joke that this is the podcast where the VCs try to shut up and the LPs are given a mic.
Yeah, exactly. Although it's really hard.
So often we just dive right into the strategy, and it's like, I mean, we look at everything almost, but yeah, it's just like the wrong moment in time, and that's not uncovered until the end of the call, and like it is what it is. But that's maybe a starting point for us when we're talking to our LPs, and then also for VCs when they're speaking with folks like us.
To that point, Frank, can you talk about some examples of fund managers who have done an amazing job of, developing and cultivating that relationship and displaying those three S's in your criteria?
Yeah, so probably the quintessential manager and that fits this mold is Founder Collective. I'm just going to use their name. They've stayed small. They've had incredible success. They claim and aim to be the most founder aligned manager out there. And I think this isn't a Founder Collective advertisement, but I think they are the exception to the norm of GPs that do have incredible success and then go on to increasingly scale their fund sizes. And for a host of reasons, the dynamic shifts, from an alignment standpoint, both with founders and LPs, the AUM kind of motivations that come into play. And then the portfolio construction and just overreaching what your brand power in the market can demand in terms of access and sourcing. And so, they've done an incredible job. I think, there's other examples out there, still, even though some of the best examples still have their best funds at funds 1 and 2.
Mm-hmm.
But if you look at, and we've done the work where you plot, some of the most successful early stage funds and then their growing fund sizes, and then add in opportunity funds, which are essentially the follow-on funds, that they raise alongside their core strategy, which, you're not supposed to, as an LP, get too distracted with. And, they're still focused on the early stage fund that's half the size as the opportunity fund. It's less a thing now, but yeah, that's, I guess, had been the norm over the past few years when capital was abundant and free flowing into venture, but probably expect that to pull back some. So yeah, FC, they're a great example. There's a few others out there, but yeah, that's one that we've enjoyed to track.
Morgan Creek also works with different organizations to help them analyze private opportunities and optimize their private asset portfolio allocations. Are there any misconceptions when working with those clients about venture, and that you would like to share with those types of organizations that would work with you all?
Yeah, so so just a little bit of context on Morgan Creek's platform. We manage both in kind of an advisory outsourced CIO model for some clients. So, full portfolio advice and across all asset classes, public, private, alts, et cetera. And then we also have, discretionary fund of funds essentially that, and some direct funds that are typically high, always high conviction areas, themes that we want to express and can add significant value. For clients that we're, advising on a portfolio level, I'm still involved in some of that work. We kind of steer them. We certainly do. We steer them away from early stage micro VCs, where I spend the 90% of my day, because most of them don't have a built out robust program for allocating to 10 to 20 managers in that space, which there's some flexibility on what that exact right number is, depending on the LP. But we do think there's an advantage with given the distributed architecture of early stage, there's an advantage with the scale that comes with allocating to early stage. So if there's not that commitment there, and we have visibility on that, we won't recommend the $25 million fund 1 and as a one-off recommendation, regardless of how much we like them for our portfolio, just because it's 9 times out of 10 not a good fit for the client. What we do instead, we do direct their venture efforts, if they want to do it direct, through more diversified multi-stage funds. Typically, if they're top tier, I think that's a great option as a single or 2 fund investments that they can get exposure. It's going to be different, right, than early stage, but it does get them some exposure to a part of the asset class. We also have utilized secondary funds that do a really good job with not necessarily accessing growth later stage companies on the high flying, like, hyperscale venture track, but still, really solid companies, often profitable, and just a unique angle to access these companies. And so those are like, we just and we also do growth, like, lower middle market kind of growth buyout type funds for clients. I think that's a really good risk adjusted return. There's a high bar there given the cost of capital has changed, but that's another area that we feel good about, putting clients in on a one-off basis, and not necessarily, the early stage micro VC, unless there's a long-term commitment to it.
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have industry expert and sponsor, one of my all-time favorite founders, John Ling, co-founder and CEO of Canopy. Canopy streamlines the administrative process. Think legal, wires, taxes, etc., for private equity co-investments and SPVs. Thank you, John, for partnering on the show. Investing in AltAssets, we've generally been talking about, for the most part, syndicates, co-investments, SPVs. Where do you think technology is going to is technology going to start playing in additional AltAssets, things like real estate or crypto projects?
I really think everything. Yeah, I really think everything. I think, you look at a lot of like real estate investing, for example, is like a really big space where a lot of people still do it on like pen and paper. They'll hire a lawyer or something, and then they'll hire like maybe like an accountant actually to do a lot of these things, right? It's not even like a traditional fund admin where it's just like, oh, like 5 of my friends, we're going to go buy this property together kind of situation, right? So there's definitely a lot of that. I think like, obviously on the commercial side, there are a lot of like co-investments that happen, but they tend to be much, much, much larger checks, right? So when you're like, okay, we're going to like pool capital together to buy this like multi-billion-dollar portfolio, like that probably like technology is probably still pretty far behind there, because like most of that work is done and drafted by like lawyers and like relationships, right? And really you end up with like a handful of players really who are doing that normally anyways, like really, really large family offices, really, really large like real estate investment firms. And I think their method of operating is probably pretty fixed for now. But I do think like if you think about even like 20 years ago when people were like running up and down Wall Street with like books. I don't know, like you watch movies and like people are running up and down. They're like, okay, wait, I've got to get this photocopy machine running so that we can print like 20 books for this like big merger conversation. And now people are more like, okay, like where's the PDF? Like I think there is definitely like a newer version of that on the horizon of like actually, hey, everyone has like the same transaction memo or whatever it is, right? I don't really know what form it takes, but I do think technology has historically always played a really big role in making these things like, more efficient. So
anything else that you think from where you sit, you could teach or uncover for our audience of VCs and LPs listening?
I don't know. I will say that like, obviously in the last 2 years, well, leading up to last year, right? 2-3 years ago, there have been like a lot of people who are like, ooh, I can be a VC, or I want to be a VC too, or whatever it is. I never done that personally. I like don't think that's a good idea. I think like it might be like a little bit controversial, but like I really don't think that like if you just because you think you can be a good investor means that like you should, because I think one, it takes up a lot of time. I think we see a lot of people who are like trying to do this as like a side gig, right? Like maybe they're like relatively high up or senior in like a big tech company, or like they are another founder, CEO, or wherever, right? Where like, hey, my company is doing fairly well, whatever. I have a lot of friends that are also starting companies. Maybe I should go run a syndicate. I'm like not a big believer in that model. I think it ends up you just do a poor job at both of the things that you're trying to do. And I think most people don't understand that the time horizon of like running a venture investment it's like literally 10 years. It's not like figuratively a very long time. It's like literally 10 years. Like you're going to be like, okay, we're going to have these LPs. We're going to like have to deliver reports or like whatever updates to them for a very long time. And I think like a lot of people think of it as like, oh, this seems like a fun like amusement ride. I'm just going to get on it. But like it's like, yes, you can, but like you have to ride that ride like 1,000 times. Like you just have to like understand that like from the very beginning.
Yeah.
So that's probably like my biggest advice is like we've obviously worked with some of these types of people, so I don't want like obviously my customers to think that I'm like saying that they shouldn't be doing what they're doing. I think I'm very happy for them. Obviously, I think if you believe that like, hey, actually venture is my calling, go and do it. But I do think that like for a lot of people who are out there thinking about it, you should really, really think very hard.
Yeah.
Yeah.
No, I think in some ways a syndicate is a great sort of you can live the life. It's like you're picking at least one deal. You're having to go raise, which you would have to do for a fund as well. You're having to write that memo and convince yourself that this is something that the people you know and love ought to be investing in as well. You're putting on the hat of wealth manager on behalf of people. And I think you're right. Like after you do that 15, 20 times in order to build your track record, maybe your conclusion at the end of the day is, oh, there's something else that this was a lot of work, and there's something else that I'd be more passionate doing.
Yeah, I think that's totally possible, right? I think like running a syndicate is okay. I think like running a syndicate, running a fund are two completely different things, right? Because like I think on a syndicate, it's sort of like a deal by deal basis. People know what they're getting into, etc. But then like when you run a fund, there's a lot more like legal structure around it, right? You kind of have like longer obligations. People will come to you and be like, okay, so what did you invest in? How are the funds doing, or whatever it is. Whereas like, I do think like syndicates are more like, okay, hey, maybe we'll just pull some capital together and like buy a house with my friends, and like, you know, at least there's software to make that very easy. So
totally. Yeah. You're officially a general manager, a general partner, as opposed to, I think the syndicate, like you kind of can offload the final decision making to whoever jumped in, that it's like, it's on you that you came in on this deal. There's a little less,
I think so.
A little less responsibility. Interesting. John, you clearly are out ahead on the future of venture capital. For those interested in using Canopy software to set up funds, manage capital, and report performance, you can please visit heycanopy.com/allocators. And then Ernest and I get credit for sending you. Thanks so much. And now back to our LP interview. Are there any other misconceptions or blind spots you see clients have, or you're focused on this area?
Yeah. So I guess, coming back to that question, so what people get wrong, I think is, so it's rooted in the kind of structure, like some of the return distribution characteristics of venture capital. There is a power law that, defines venture capital more so than any other asset class. And the degree is that it does, is so extreme that even within our, global diversified fund of funds across all asset classes, we've had venture dominate the overall returns. So I guess, what does that mean for allocators, and where do those misconceptions come up? I think it's like, we look at the power law, it's the strongest for early stage. It's been demonstrated with data for different reasons. But if you're an allocator, a lot of times you think you can kind of helicopter in, be a little bit opportunistic, tactical, like now when the market changes and get some exposure. I think that's a really big misconception. It's an evergreen asset class, but it also takes ongoing commitment to the asset class to participate in what it can offer, essentially. And for example, like if you missed out on the returns or were gun shy several years ago and didn't participate in the past liquidity that happened over the past few years, you're going to miss out on a lot of the returns to be had. So yeah, I guess trying to be opportunistic in the asset class doesn't work. There's also kind of network and relationships that form around venture that make it harder to be tactical. So if you're kind of swooping in to get access to a top tier fund, that's definitely not going to happen. And then even if you're trying to source early stage funds that are less of an access play, you're just not going to be in the flow to know who they are. So yeah, I guess, opportunistically waiting in and out is one. The second would be kind of having too small of a aperture into the space, and then doing kind of what comes through your door. If you see 10 funds a year, some of those funds can look really great. But the thing that I've always been surprised by in this, especially early stage ventures, like the caliber of the next VC that comes through. So I don't necessarily, I get really excited about certain VCs and the opportunities they're investing into, and ultimately the founders that they're finding. And but there's always it seems someone that like one ups. And if you look at 5, 6, 7 managers that find you somehow, if you're one of a family office or endowment, and pick 2 of them, that's a very suboptimal strategy. So there's this aspect of relative evaluation in early stage, which matters a lot, not just from gauging overall quality and caliber of these managers, but also considering where you have diversification or not on a portfolio level in terms of network overlap. So that's something else we look at. So if you back 3 funds that all tie back to Y Combinator, that's not going to be a well-rounded strategy, and you're going to decrease your chances of capturing those outlier returning companies that are not necessarily going through YC always. So you need that diversification. And maybe just to wrap up this last kind of misconception of like you can do venture by rifle shotting a few a year and not really mapping the landscape. There's been I think it's from Samir over at Allocate, Samir Kaji. I think 2,500 or so VCs started since the GFC, and it's maybe used to in the early 2000s you could meet with 30 managers. That was all the early stage managers there were, do half of them, and that was a really great strategy. Today, like you're not going to meet with all 2,500, right? And there's question on whether or not you can even, if you could even select. So I think the starting point is to at least start doing the legwork, and it's a ground game. And we've done almost 450 GP meetings in the past year.
Wow.
And providing that context on where you want to spend time, what networks are relevant, like who's on who is generating a signal to the downstream investors, that back to the point of key nodes. And like you catch a one-off and they can look great, but when they're put into context, it really kind of opens up your eyes to how exciting the opportunity is out there, and how much work goes into it.
Yeah. I interned with a big fund that they made you stack rank at the end of the week. And I think you're absolutely right that like the thing you were excited about on Tuesday, somebody's come in Thursday and you're like, this is my new number 1. And
that is the hardest part of the job. And we ultimately try to build portfolios of 10 to 20 managers. There's a lot of folks that clear the bar. So selecting, and we think 20 managers is sufficient for the diversification we're looking for. But yeah, it's even selecting among those, it can be tough.
Okay, so maybe Ernest or Frank, what are those hype cycles that we are just entering? Like what's percolating in 2024 that I don't know. Right now, you see like fintech people are just like jumping off buildings. What are we just starting to see?
Well, Ernest, if you have any.
Well, I think the hype is around AI and everything AI, and it's similar to when you talk to more senior folks of the .com era. And it's not like great companies aren't going to come from that, but I think we've been able to see a jump from people going from one hype cycle to the next. And so going from, Web3 now to like putting an AI on it. And so it's our jobs as venture capitalists to really suss through what's an actual business and not what's an actual business and what's not just a wrapper around, Gen AI. So.
Yeah, no, 100%. Like AI is and continues to be the current, hype hype source for the industry. They're immune to any reset that we've seen across all other sectors. I think like looking out, like what's the next one? I think is the big question, right? I don't think AI is going away. It's going to really disrupt some existing industry sectors and in some really cool ways. And I think like there will be money made there. I think like we're probably moving to the application, layer for AI and how that maybe intersects with Web3. There's some really good, articles, papers written on that topic. But from an allocator and kind of venture perspective, deep tech is kind of probably the most obvious one that's kind of next in line. And I'm still a little bit torn on like or just undecided on if this is a pure hype or what kind of how much there is here. And I think like the one way that this could be non-consensus is that a lot of allocators investors are restricted on this opportunity in some ways, just given the past kind of geopolitical landscape and how much politics do play into, especially for any type of public institution, the allocation policy. So like that there might be some capital constraint, which is actually helpful from a return standpoint. And there's just a lot of white space within deep tech. So like stuff like advanced manufacturing or life sciences and tech bio and other spaces like defense, space. Actually, like there's a lot of areas that just haven't had the time and kind of maturation cycles that like enterprise SaaS has had, and which to me speaks like opportunity. I think the one caveat there's serious consideration around the dollars needed to scale some of these business models, where the VC platforms come in. I think that will be really, very helpful, but there'll still be that kind of 0 to 1 kind of seed investor that could capitalize on that opportunity. And then stuff that's like way out of vogue right now, the obvious one, consumer, right? So like, what in the next 5-10 years will have something like potentially venture scale big outcome? I think it could be consumer. Like it's been, shunned for the past several years, and we have some really interesting stuff in our portfolio within consumer. But to that point of finding value as a seed investor and kind of going against the grain sometimes, I think like is helpful from a return standpoint. So yeah, it's incredibly exciting. Part of the reason I love being in this space.
Yeah. Well, Frank, as a parting, we just wanted to know if obviously you're meeting with a lot of managers and your firm is meeting with a lot of organizations that you serve as an outsourced CIO. If they want to reach out to you, how do they get in touch with you, and who ideally should reach out to you?
Yeah, easy to find on LinkedIn. Usually lots of mutuals, so feel free to get a warm intro, and that's usually a good route. My email is ftanner@morgancreekcap.com. And the folks that should reach out, anyone that's looking for exposure to this space from an LP side, absolutely can help. We have, some educational content. Those papers that I shared with you all and others like have been really well received, and I think there's a really great conversation around this early stage opportunity that's happening right now. So happy to be maybe somewhat of a guide in that discovery process. We also have products that we routinely launch and deploy. And then maybe most importantly from the kind of investment side, if you're a GP early stage, typically sub $100 million funds are what we look for. Yeah, please do reach out. Like we literally process everything. We're set up to do that. So we will look at a deck if you send it to us and discuss it in a week or two with our process. And then more often than not, we take a call if you kind of check those initial boxes of size, portfolio construction, stage, and yeah, so any new GP, and we do a lot of fund ones. Half the funds we've done are fund ones.
So helpful. Thank you, Frank. This has been a lot of fun.
Yeah,
Thanks, Frank.
thank you. It's been great.
See you later, allocator.
After Portfolio Tile, investing with a smile.